the term miner does make sense in a particular context as an analogy for what proof of work does, because there's two parts to proof of work. One is adding new Bitcoin to the ledger. So this is called the subsidy, and it really represents a transfer of Bitcoin from the issuance schedule of that 21 million Bitcoin to the UTXO set that is able to be used for transactional purposes. So that subsidy, the issuance of new Bitcoin, is what Satoshi analogized to gold mining, which is extracting the commodity from the ground using work so that it can be usable, so that people can transact with it. So I think it's fine as an analogy. It does, however, miss the second part of what proof of work does, which is proof of work plus the difficulty adjustment. And this is what some folks refer to as the time chain, which is basically this concept that Bitcoin mining is a decentralized clock. And so a block comes out every 10 minutes. And if blocks are coming out too quickly, then the Bitcoin nodes increase the difficulty. And that happens every 2016 blocks. And if they increase the difficulty, that means that it goes back to being every 10 minutes and vice versa. So they can also decrease the difficulty if blocks are coming in too slowly. And that's a way of essentially rate limiting the miners so that the miners don't produce too many blocks too quickly. And it allows Bitcoin to really be a very dynamic and anti-fragile system in that regard. So timestamping is a way of capturing that second functionality. And really, though, I shouldn't say it's the second functionality, because if we look at what is actually innovative about Bitcoin, that timestamping is Satoshi's invention. It is the solution to the double spending problem. And that is what really makes Bitcoin, a novel system. So I think that bringing that back as and emphasizing that really, that problem of double spending, of spending the same coins twice. This is the first time there has been a decentralized solution to that, and without this decentralized clock that is ordering transactions over time, there really would be no way to have a decentralized ledger. And there would be no way to have any kind of digital scarcity. So it's all deeply interconnected of Bitcoin miners using work to convert energy into time.
Can you touch on that, on what if our miners really in control of the network, and what do you think about that?
Yeah, that's a good insight. So because miners are the ones that are creating blocks, there's a perception that they determine the rules for the blocks. The reality is that miners are just proposing blocks, and then the network of nodes are verifying that the block is following the expected rules. And this isn't just like a theory of mine. If we look at what happened a few years ago, there was a mining pool called F2 Pool, and they created a block that accidentally created more Bitcoin than they were entitled to. And so it was an invalid block because it did not follow the rules of the Bitcoin protocol as implemented in the node software. And so all of the nodes rejected that block as invalid, and F2 Pool lost out on that revenue. So it's really important to keep in mind that Bitcoin as a system has checks and balances, where the miners are proposing blocks, but ultimately any node can veto a block for themselves. It's not really the complexity of the math problem, it's how many times you have to do the math problem that is challenging. And so it's a lot more like trying to enter lots of lottery tickets into the lottery so that you get lucky enough to have the right numbers. drawn, every 10 minutes. So, luck is a factor in Bitcoin mining, but ultimately it's about how many hashes can you generate and to find enough leading zeros. Instead of thinking about Bitcoin mining or proof of work as computer servers that are generating cryptographic hashes, they start thinking about it as like mineral extraction from the soil. And if you go into a Bitcoin mining facility, there's no CO2 emissions going on inside the facility, right? There's just a bunch of servers that are operating at 100% and generating hashes. So I think that's the other problem with the terminology of mining, is that it gives people kind of a bias that this is terrible for the environment, when in reality, it's no more terrible for the environment than running a search query on Google. I think that it's really important when analyzing the Bitcoin mining market to connect it with kind of the real world logistics of the supply chain. And so there is a tremendous lag, anywhere from 12 to 18 months, between what the Bitcoin price is doing on the spot market and how long it takes to build up infrastructure to host miners, to get deliveries of mining rigs, to plug them in. So I think that's why hash rate was hitting records, even though spot market was struggling. And that created a really challenging situation for Bitcoin mining industry participants. Riot's strategy through this has been to be a low-cost producer of Bitcoin, meaning that even if the Bitcoin price is decreasing and that's compressing margins, that we're still, profitable and able to, and I mean profitable at the machine level. I don't want to get into public filings or anything like that, but we're a public company, so you can go see our financial statements and look at that yourself. But basically, the idea here is that if you're going to be a Bitcoin mining company that lasts through the cycle, one, you have to have a strategy that accepts Bitcoin's volatility. If you try to deny Bitcoin's volatility, then you're going to face financial difficulties when that volatility materializes. And we've seen a number of companies fall into that situation over the past 12 months. So the other part of it is that electricity prices can also fluctuate significantly. And so in a way, it was a bit of a perfect storm because of Russia invading Ukraine and causing natural gas prices to go up, and also just general inflation pressure throughout the world. That drove up electricity prices, meaning that Bitcoin miners were getting squeezed on both sides of electricity prices going up and Bitcoin price going down.
Financial products that to help miners hedge this hash rate or difficulty risk. Is this something that miners are considering, or in your opinion, what will be a good solution to manage this type of risk?
The best solution for managing that risk is to plug in more miners, right? If you're concerned about losing your share of the hash rate, right, what percentage of the hash rate you have, your market share, then no amount of financial contracts are going to make you more competitive. You're just going to give money to third parties. What you've got to do is either accept your fate or get to work, right? And grow.
So would you say generally, is that just a kind of hold strategy from like the financial perspective, or is there anything else going on there sometimes?
Yeah, it's really, it's a hold strategy. And it really, I mean, it's about Bitcoin's fundamentals as a scarce commodity. that is currently, from my point of view at least, deeply undervalued by the market, and so it just makes sense to hold it.
So what do you think, why did miners come to the USA, and where are they located, and why, what's the why are they located where they are?
Yeah, great question. I can speak to Riot. What makes a lot of sense about Texas is, one, on the energy level, and you've got to start there, is energy, because that's the most important qualifier, is what is your cost of electricity. And Texas has a unique combination of abundant renewables, wind and solar, and abundant reliables, natural gas. And natural gas is the most cost-effective, reliable source of electricity. Second is the property rights and institutions. All right, so there, I think Texas is a leader. And so making sure that you have rule of law, and that, what happened in China was undemocratic, right? They unilaterally decided to crack down on Bitcoin mining without any kind of public debate or vote or conversation around it. And that's, I think, those are the two key elements. And then there's also just the physical infrastructure. Is is it buildable, or does it already exist? And so I think that's why the United States in general has attracted a lot of Bitcoin miners, is that you can still build things in the United States.
A lot of miners in China, right? It's like centralization, but now we have a lot of on the USA. Do you think there's also a risk for Bitcoin mining, that kind of concentration in the USA, with maybe regulations coming for miners, or that this debate about the environment, right? That maybe Bitcoin miners are not good for that. Do you think that's a risk, or how do you see that?
Yeah, good question. So I think that throughout my time in Bitcoin, until I guess 2021, when China, really reduced the amount of Bitcoin mining going on. Although there's still, I think, an estimated 20% of the hash rate in China, which is really interesting. There's been this overarching concern about how much hash rate is in China, and what the 2017 block size war and debate really revealed was that it doesn't matter how much hash rate is in any particular jurisdiction, or how much hash rate is behind a protocol change, because the miners were, I think, more than 90% were signaling for a hard fork to double the block size limit to 2 megabytes. And ultimately they failed because of Bitcoin's decentralized governance, but maybe that's why the Chinese Communist Party decided to kick them out, is that their presence in China did not actually give China any control over the network. And so there's not really any strategic interest to have Bitcoin mining in your country. Now, as for the situation in the United States currently, I think that it's very instructive to show that the ban or the reduction in mining in China, that did not just make mining go away. All it did is it pushed it offshore. And so if the United States were to pass regulations that are that make it uneconomical to mine Bitcoin in the United States, that just means that Bitcoin mining would move to other jurisdictions, or it would go underground like it did in China, where there's still 20% of the hash rate. And from a policy perspective, there's two consequences. One is that the government doesn't collect tax revenue if Bitcoin mining is done on the black market, which, you know, depending on your political perspective, is a good thing or a bad thing. Two is that Bitcoin mining then uses electricity that is being generated by you know, more CO2 emissions than otherwise would happen. Uh, Basically, the a Bitcoin mining facility like Riot's has a more renewable footprint than a Bitcoin mining facility in Kazakhstan that is operating on 100% coal, right? In Texas, it's more like 50% renewables. So, you know, pushing Bitcoin mining abroad would cause more CO2 emissions, not fewer. So I don't think that there's a strong policy argument for the folks who want to crack down on Bitcoin mining in the US. But the debate has to happen in any case. And it is what it is.
Action by the SEC recently in a number of things. I think they actually finally got around to taking action on Do Kwon actually the other day, which took a while. And obviously with Kraken, we saw that there was a settlement there with their staking services and a few other things. So I'm curious, just kind of from a broad perspective, you know, because obviously a lot of this relates to crypto and digital assets other than Bitcoin. But do you think, or do you see, whether it's like the SEC or is it the CFTC? Do you see any potential actions or movement from these players into Bitcoin and trying to either put forward some enforcements or some regulations? Curious to know your thoughts in that space.
Yeah, good question. So I think that there fundamentally is just uncertainty in this area. The current status quo is that unofficially Bitcoin BTC is a commodity, and that if we just take that status quo for granted, from the financial regulatory perspective, they see a gap where spot BTC trading is not regulated because the CFTC regulates commodity derivatives, but does not have a mandate for regulating commodity spot markets. And so they see a gap there. Then the debate evolves into, well, the SEC has a much longer track record of regulating trading that is more oriented towards retail investors and traders. And so wouldn't it make more sense for the SEC to have jurisdiction in this area than the CFTC? So I think that's where the debate is currently at. And it's complicated because simultaneously you have these two executive branch agencies trying to regulate, and also that the legislative branch is trying to legislate and try to come up with a solution. So I don't know if there's going to be a solution this year or in the foreseeable future, but that's kind of the current tension over Bitcoin spot trading specifically. Now, there are, you know, if we zoom out, other than Bitcoin spot trading and look at one, on the Bitcoin mining side, there has been interest from the White House in better understanding Bitcoin mining, to put it charitably, and they want to see if the Department of Energy or the Environmental Protection Agency should have a role in gathering information about Bitcoin mining and perhaps setting what they call efficiency standards, which is a big open question. So the White House Office of Science and Technology Policy has put out a request for information about what should the federal research agenda for digital assets be focused on. So that is due March 3rd for folks who like to respond to the government. I've drafted a response. We'll see if Riot sends it in or not. It'll just depend on whether it's a good response or not. But in any case, so there's kind of there is at the federal level interest in the energy angle, but ultimately, I think what is particularly impactful for this space has to do with Bitcoin adjacent assets, right? In the crypto space of, for example, stable coins. There is active debate about how to regulate stable coins. And a major risk here would be that the SEC will decide that all stablecoins are unregistered securities, and that they all are more like a money market fund than a token. The industry tries to characterize as that. So I don't know how that would impact Bitcoin. Perhaps it would be bullish for Bitcoin, because really, if the government is okay with centralized stable coins, then it really calls into question why we need Bitcoin, at least at the medium of exchange level. Maybe it still makes sense for the digital gold store of value that, Bitcoin can't be diluted. But for the medium of exchange payment side, a centralized stable coin, there seems to be a lot of interest in using that for payments rather than Bitcoin, if the government allows those things to exist. And these things, they exist at the benevolence of the government, because ultimately a centralized stable coin can have its bank account seized or frozen, and it immediately goes to zero.
I'm curious to know your thoughts about CBDCs, especially as it relates to how it might affect Bitcoin. Do you think that it is a challenge to Bitcoin, or do you think in the long run it actually makes Bitcoin's case more bullish?
Yeah, so I think everything's always good for Bitcoin. CBDCs, I mean, to me, CBDCs continue the long tradition of governments creating more currency. And so to the extent that they are dilutive, that will be to Bitcoin's benefit.
What do you think about Bitcoin dilution regarding perpetuals and the derivatives market? And do you see any parallels to do you see any parallels to the commodity markets with gold and silver or other commodities?
Yeah, so if we look at Bitcoin's price history and the history of the derivatives market in Bitcoin, because of the volatility, we've seen a lot of leveraged traders get liquidated. And so trying to manipulate the Bitcoin price using derivatives is a great way to get yourself liquidated on a long enough time frame. So I'm very skeptical that that's going on. One could imagine that the Federal Reserve or a central bank that has infinite amount of fiat currency could, avoid getting liquidated and build up very large positions to try to manipulate the Bitcoin price. That's possible. I mean, I still think the outcome would be highly inflationary, because they're introducing so much fiat currency into the system in order to manipulate the price that ultimately, like, Bitcoin's price, and any market price, long term is going to reflect fundamentals. And so I think that people who talk about gold price manipulation are kind of in a state of denial about how bad gold's fundamentals are, and are trying to find ways to rationalize why the price is not where they expect it to be, rather than accepting that there's a better alternative now in Bitcoin.